Welcome, class. Get your notebooks out, pens ready, and keep your eyes glued to the screen. Because today, we are doing a complete postmortem of two companies hitting the market at the exact same time. But honestly, they couldn't be more different. On one side, we have a tiny IT player. On the other, a massive industrial machinery giant. Both IPOs are making serious noise right now, but as your strict analyst, let me be clear. We don't care about the market hype here. We care about hard, cold facts. So, let's get to work. Now, let's jump straight into the big question. When a company goes public, they have a motive, right? Model 1 is a fresh issue. This is where your money goes directly into the company's bank account to literally fuel their expansion. Model 2 is OFS, or offer for sale. This is just early investors cashing out their chips and exiting. Today's two IPOs, they are literal textbook examples of these two polar opposite models. So the real question we need to answer today is, as a smart, calculated investor, where should your hard-earned capital actually go? All right, here is our syllabus for today's session. Pay attention. Part 1, the complete truth behind Xtranet technologies. Part 2, what exactly is so special about Lohia Corp? And Part 3, the final face-off and our verdict. Let's move. Starting with Section 1, Xtranet technologies, the complete truth. Look, as serious investors, I need you to look past just the profit margins and actually understand the engine driving the business. When a microcap asks the public for money, you have to read every single page of their file. Xtranet isn't some brand new startup. They've been around since 2002, providing end-to-end IT solutions. ERP applications, managed services, that sort of thing. But here's the catch you absolutely must note down. Over 35% of their total revenue comes purely from selling hardware and products like servers and security modules. So they aren't a pure-play software company. They're really more of a hybrid IT infrastructure setup. Okay, let's look at the hard data. This IPO opens from July 23rd to the 27th, with a tentative listing on the 30th. It's a 117 crore rupee issue. But the absolutely crucial detail here, it is a 100% fresh issue. That means every single rupee you invest in this 120 to 127 rupee price band goes straight into the company's veins. No old promoters are running away with your cash. The capital is strictly for repaying debt and funding working capital. From an academic standpoint, that's a very positive signal. And you know what? That capital injection makes total sense when you look at their financial health. Their recent growth has been phenomenal. Revenue is up by 32%, and their profit after tax has jumped 36%. Return on equity is sitting at an impressive 44%, with return on capital employed near 40%. For any IT company, those are highly attractive numbers. Add in a debt-to-equity ratio of less than 1 and solid EBITDA margins around 17%. Honestly, on paper, this balance sheet would make even the strictest finance professor smile. Hold on, no, don't get carried away. We have to look at the other side of the coin. Sure, the strengths are obvious. A 100% fresh issue with a reasonably attractive post-IPO PE ratio of about 16. But mark these risks in red ink. A massive 86% of their revenue comes from just their top 10 customers. That is huge concentration risk. And worse, 47% of that is directly dependent on PSUs or government contracts. And you all know what government contracts mean. Delayed payment cycles and extremely high working capital needs. Plus, right before this IPO, their debt suddenly spiked. That's a glaring red flag we literally cannot ignore. So, how is the street reacting? Well, despite those risks, the gray market premium is hovering around 20%. Meaning, on that 127 rupee upper band, you're looking at a 25 to 26 rupee profit right out of the gate. The market is comparing them to bigger players like Coforge and Silvertouch. But remember my rule for this class. GMP is just the direction of the wind today. It completely ignores the actual balance sheet reality and that massive customer concentration risk we just talked about. All right, moving on to Section 2. Lohia Corp. What exactly makes them special? Shift your focus now, class. We are moving from a microcap IT setup to a literal manufacturing giant. Lohia Corp's scale and structure is worlds apart from Xtranet. They're a heavyweight in the textile machinery sector. Now, while this specific entity was only incorporated in 2023, their actual footprint is massive. They build the machinery used for making woven plastic bags, tarpaulins, and fabrics. Get this stat. They alone command roughly 41% of the Indian raffia machinery market. And it's not just one-off machine sales. They generate highly stable recurring revenue through spare parts and maintenance. But look at their IPO structure. It goes in a completely different direction. Also opening July 23rd to 27th, listing around the 30th. But check out the size, 1,101 crores. And here is the kicker. It is 100% offer for sale, an OFS. This means that the 400 to 425 rupee price band, not a single rupee of your investment goes into Lohia Corp itself. Every dime is going straight into the pockets of existing shareholders who are cashing out. This is the exact opposite of what Xtranet is doing.
If we pull up their financials, the numbers here are also stellar. Their profit after taxes surged by 64%. Both ROE and RSC have easily crossed the 30% mark. And what's really impressive for such a heavy manufacturing setup, their debt-to-equity ratio is practically non-existent, less than 0.5. So they are carrying almost zero debt burden while maintaining incredibly strong profitability.
Let's weigh this neutrally. Their core strengths are undeniable: massive market dominance and high margins. Plus, even with 100% OFS, the promoters are holding on to about 75% of the company post-IPO, which definitely shows they still have skin in the game. But do not gloss over the risks. Beyond the OFS cash out, 88% of their revenue comes from just one machinery type, raffia. If demand in that specific industry dips, Lohia takes a direct hit. Add to that, 42% of their revenue comes from exports, leaving them highly exposed to global economic shifts and foreign exchange risks. Now, let's talk GMP for Lohia. Stacked against peers like Raju Engineers and Jyoti CNC, the gray market is giving this large cap an identical 20% premium, so roughly 80 rupees per share. Honestly, it's pretty wild. The market expects the exact same 20% pop for a high-risk microcap IT firm as it does for a massive, slightly slower growth manufacturing giant. It just proves that in the short term, the street is completely blind to fundamentals and is only looking at liquidity and hype. Which brings us to our final section, the showdown and our verdict. All right, class, time to synthesize our notes. We've dissected Xtranet's aggressive growth and Lohia's massive empire. Let's look at them side by side. On the left, Xtranet, a tiny 664 crore market cap, funneling 117 crores of fresh capital directly into the business, sitting at a fairly cheap 16x PE. On the right, Lohia, a 4,490 crore giant, where a massive 1,101 crore OFS is going straight to exiting investors, demanding a slightly premium 23x PE. Yet, both are sitting at a 20% GMP. One is a small guy funding expansion, the other is a big guy cashing out. The dynamics are literally polar opposites. So what's our neutral takeaway here? Xtranet is going to appeal to those of you chasing high-growth microcaps, and we're perfectly willing to stomach the risks of delayed government payments and massive customer concentration. Lohia Corp, on the other hand, is for those who prefer absolute market dominance and stable profit margins, assuming you're okay with the fact that your IPO money isn't funding company growth and that their entire fate rests on a single machinery sector. And that brings us to the most important question of today's class. The GMP might be flashing a matching 20% for both today, but structurally, their risk profiles are like night and day. As an investor, you have to ask yourself, are you willing to strap in for the turbulent, high-risk ride of a microcap expansion, or does the large-cap OFS cash-out structure suit your portfolio's appetite better? Know your own risk tolerance and make your decisions based on the data, not the hype. Class dismissed. Thanks for tuning in, and I'll see you in the next deep dive.